On November 6, 2023, a company once valued at $47 billion filed for bankruptcy with $18.7 billion in debt and $15.1 million in assets. Not billion, million. The gap between those two numbers is the most expensive delusion in the history of venture capital. A founder who personally charged his own company $5.9 million for the trademark to the word we. A business that lost $1.9 billion on $1.8 billion in revenue, meaning every single dollar that came in the door left with a friend. In a 12-minute meeting with a Japanese billionaire that unlocked more capital than most countries spend on infrastructure in a decade. Everyone blames Adam Neumann. The private jets, the tequila, the marijuana on international flights. And sure, that's a fun story. But eccentric founders run successful companies every single day. It wasn't the spending. It wasn't the pandemic. It wasn't even the corporate governance. The thing that actually killed WeWork was hiding in plain sight from day one, baked into 3 words that nobody questioned until it was far too late. In 2008, in the Dumbo neighborhood of Brooklyn, an architect named Miguel McKelvey and an Israeli entrepreneur named Adam Neumann opened a small co-working space called Green Desk. McKelvey had spent years at a boutique firm called Jordan Parnis Digital Architecture, where he'd learned to convert raw commercial space into stylish interiors on the cheap, fluorescent lights, wire racks, exposed brick. Fast, affordable, Instagrammable before Instagram existed. By 2010, Neumann and McKelvey sold their stakes in Green Desk and poured the proceeds into a new venture. They called it WeWork. The timing was surgical. The 2008 recession had flooded cities with empty commercial real estate. Interest rates were near zero. Developers had built glass towers with no idea who would fill them. And suddenly here was this charismatic, 6'5" Israeli guy promising landlords he'd take their empty floors off their hands with long-term master leases. The model was elegant. Sign a 15-year lease at wholesale rates. Spend McKelvey's playbook, 8 to 12 weeks, converting the space into a design-forward office with craft beer on tap and neon signs that read, "Do what you love." Then sublease individual desks and offices at a massive markup on month-to-month terms. The delta between wholesale and retail was the margin. Venture capital flooded in. By 2014, WeWork was valued at $5 billion. By 2017, $20 billion. And then Masayoshi Son of SoftBank toured WeWork's headquarters for 12 minutes, called Neumann a visionary, and cut a check that pushed the valuation to $47 billion. WeWork was the most valuable startup on earth. Except it wasn't a startup, and it definitely wasn't tech. Here's where the story gets strange. Neumann didn't pitch WeWork as a real estate company. He called it a physical social network offering space as a service. He told investors they were buying into a platform, not a portfolio of leases. WeWork even built an internal social network called WeWork Commons so members could connect. They hired over 1,000 engineers across 4 global hubs. They developed algorithmic tools for real estate sourcing, feeding data on foot traffic, demographics, and competitor pricing into models that would spit out recommendations. Should they open a 61st location in New York City? The algorithm would say yes. Or no. Or maybe. They used building information modeling to standardize every office worldwide. The same partition systems in Tokyo and Berlin. The same wallpaper in Mumbai and Melbourne. The same seat-to-office ratio, the same bike racks, the same generic wall art. This was the pitch. WeWork could scale space the way software companies scale code. Deploy a template, replicate globally, iterate at the margins. And investors believed it. Because if WeWork was a tech company, its losses weren't losses. They were investment in growth. Amazon lost money for years, right? Netflix burned cash for a decade. If WeWork was a platform, then every new lease was a node in a network that would eventually generate exponential returns. But here's what nobody wanted to say out loud. Every time WeWork deployed a node, they signed a 15-year financial obligation backed by nothing but month-to-month tenants who could leave whenever they wanted. Software scales at near zero marginal cost. Real estate scales at the exact cost of the next building. By 2017, the numbers were already screaming. WeWork lost $883 million on $886 million in revenue. That's a loss ratio of nearly 1-to-1. But the company kept doubling. Locations, memberships, headcount. every single year. When they turned to the bond market in 2018 to borrow hundreds of millions more, the filings revealed the full picture. Losses had more than doubled to $1.9 billion. Revenue per user had actually fallen 6.2% the prior year, while sales and marketing costs tripled. And Neumann was buying buildings personally, then leasing them back to WeWork. He'd taken out personal loans from the company. He charged WeWork $5.9 million for the trademark "we," a word, then returned it in stock only after the press caught fire. His wife, Rebecca, reportedly fired employees for having bad energy. The company once announced layoffs and then immediately brought out a member of Run DMC to perform for the remaining staff. But none of this was secret. The Wall Street Journal's Elliot Brown had been publishing WeWork's numbers since 2017. The headline read, "A $20 billion startup fueled by Silicon Valley pixie dust." NYU professor Scott Galloway called the company WTF and said any analyst who believed it was worth over $10 billion was lying, stupid, or both. So why did the money keep flowing? Because as long as WeWork stayed private, nobody had to prove the math worked. SoftBank's Vision Fund had already invested billions. Admitting the thesis was wrong meant writing down the fund. So they doubled down. And then they pushed for an IPO. That was the moment the illusion had to survive contact with public markets. And it didn't survive for 6 weeks. On August 14, 2019, WeWork filed its S-1 prospectus. Inside was a phrase no Wall Street analyst had ever encountered: community-adjusted EBITDA. The company had invented its own profitability metric by stripping out not just the usual items, but also marketing costs, administrative costs, and design expenses. Essentially, WeWork was profitable if you ignored most of the costs of running WeWork. S&P rated them junk. Fitch rated them junk. The proposed valuation cratered from $47 billion to under $10 billion in weeks. By September 24, Neumann voted to remove himself as CEO. The IPO was dead. SoftBank swooped in with a $9.5 billion rescue package, taking 80% of the company. Neumann walked away with a package reportedly worth up to $1.7 billion. Meanwhile, 2,400 employees, nearly a fifth of the workforce, were laid off with uncertain severance. WeWork eventually limped onto the public markets through a SPAC in 2021 at a fraction of its former valuation. Then the pandemic's aftershocks hit. Remote work gutted demand. Interest rates rose. Commercial real estate cratered. The stock fell 99% in a single year. On November 6, 2023, WeWork filed for Chapter 11 bankruptcy. Valuation at filing: less than $50 million. $47 billion to $50 million. A destruction of $46.7 billion in value. Adam Neumann left with $778 million. So what actually killed WeWork? Not Adam Neumann's ego. Not the pandemic. Not even the corporate governance, as catastrophic as it was. Those were accelerants. The fuel was already there. WeWork died because of 3 words it told itself and the world from the very first pitch deck: space as a service. That phrase performed a magic trick. It took a business with the unit economics of commercial real estate, long-term fixed liabilities, capital-intensive build-outs, geographic constraints, and dressed it in the valuation framework of a software platform. And everyone went along with it because the upside was too intoxicating to question. Compare WeWork to IWG, the parent company of Regus, which has operated co-working spaces since the 1990s. IWG runs more locations than WeWork ever did. It's profitable, and it's valued like what it is, a real estate services company. IWG's model: they partner with landlords, splitting revenue instead of signing long-term leases. They carry almost none of the downside risk. They never called themselves a tech platform, so they were never valued like one, and they never had to grow at a pace that only a tech platform could justify. WeWork's fatal flaw wasn't operational. It was ontological. They misclassified what they were, and then they built an entire growth strategy around that misclassification. Every lease they signed, every location they opened, every engineer they hired to build algorithmic space planning tools, all of it was downstream of one foundational lie about the nature of their own business. A real estate company that believes it's a tech company will spend like a tech company, hire like a tech company, and grow like a tech company. But it will die like a real estate company. Because when the market turns, You can't just spin down a server. You're stuck with 777 buildings in 39 countries, each one bleeding cash on a 15-year lease that doesn't care about your burn rate. If you're building something right now, here's the question that could save you. What are the actual unit economics of my business, stripped of every analogy and every narrative? Not, we're the Uber of X, or we're the platform for Y. What does it cost to deliver one unit of your product to one customer? And does that number improve as you scale, or does it stay the same, or get worse? WeWork's cost to serve one more member was another lease, another build-out, another set of furniture, another keg of craft beer. That's not a platform. That's a franchise without the franchise fees. The moment you confuse your story with your structure, you start making decisions that only make sense in the story. And the market doesn't read your pitch deck. It reads your P&L. If you want to see what happens when a company makes the opposite mistake, builds genuinely transformative technology, but completely misreads the market it's selling into, watch our episode on Quibi, the $2 billion streaming service that died in 6 months. The parallels to WeWork are unsettling, and the differences are even more revealing.